There are a lot of acronyms in real estate, and one of them is FIRPTA. Yes, FIRPTA, F-I-R-P-T-A. Now, it's not going to mean a whole lot to you unless you really need to know about it, and then it's going to be really, really important to you. Okay, so FIRPTA stands for Foreign Investment in Real Estate Property Tax Act of 1980. Sounds exciting, right? No, not really. Okay, but if you're a foreign person and you're selling your property, or you're a buyer and the seller is a foreign person, you really do need to understand a little bit about FIRPTA. Hi, I'm Jill Thomas with Berkshire Hathaway HomeServices, Florida Realty, and I'm going to try to make a sometimes dry topic a little bit more exciting or interesting so you can understand how FIRPTA, this tax act, could impact you. FIRPTA is important for you to understand if you're a foreign seller or if you're a buyer purchasing a property owned by a foreign person. Now, please know I'm not an accountant or an attorney, and if you're a foreign person selling your property, I highly recommend that you contact an accountant that specializes in FIRPTA. Now, there's a number of accountants in our area who can do that, but there's one accountant in particular in Sarasota that has become known as the local pro. And so if you need her contact information, I can provide that to you. Just give me a call. Here's the quick and dirty on what you need to know about FIRPTA. Number one, the purpose of FIRPTA. Now, when someone sells a property in the United States, there are potential tax implications, especially if this isn't your primary residence. So if that seller is a foreign person, the IRS is going to want to make sure that they get whatever their piece of the pie is when that owner sells the property. So FIRPTA was put into place to help guarantee that the IRS gets what's due to them. Number two, withholdings. So this is how the IRS goes about making sure they get their money, okay? I'm going to explain it to you in technical terms, and then I'm just going to give you the really short version of it. All right, so just hang tight with me on this one. Okay, a foreign person sells U.S. real estate, then he or she is going to be subject to 15% of the gross price withheld from the proceeds that they receive at closing. So it's going to show up on the settlement statement. 15% is going to be out of there. Okay, and then it then must be remitted to the IRS no later than 20 days after that. Now, this 15%, it's no relation to the actual amount of tax that they're going to owe on that sale of the property. Now, once the actual tax is calculated on the U.S. income tax return that seller is going to be required to fill out to report the sale, the actual amount of withholding is going to be compared to the actual tax on the sale. So let's suppose the tax is less than the withholding. Then the difference is going to be refunded to the seller. If the tax is more than the withholding, then the seller will have to pay the difference to the IRS. So here's the really short version of this. All right, foreign person sells a property, 15% is withheld. It goes straight to the IRS. Then in time, seller is going to file U.S. income tax report on that property, and then they're going to get a real number on how much tax is due on because of the sale of the property. If it's less than 15%, seller gets money back. If it's greater than 15%, seller owes the IRS money. Okay. Now, number three, what does this mean to the buyer? Okay, if you're a buyer and a U.S. resident, you might think, well, big deal, the seller owes the IRS money. A lot of people owe the IRS money. So what does this actually have to do with me? Well, actually, a lot. The way this tax was written, it's the responsibility of the buyer to make sure that the 15% is withheld. And I'm going to say that again. The way this tax act is written, it is the responsibility of the buyer to make sure that that 15% is withheld. Okay, sounds crazy, right? Yes. Well, don't fear though. The attorney or title company handling the closing is accustomed to this process, and they're going to take care of all of this for you on your behalf. But nonetheless, it has to be done. And it doesn't cost you any more money for them to do that and handle that. That's just part of everything that they do. But the reason why the IRS puts this on the buyer to make sure that the money is withheld is because let's suppose the seller decides they don't want to pay for the taxes owed on the sale of the property. The IRS wants their cut from somebody, so they're going to go to the buyer, and the buyer would owe the IRS that money. So that's why it's on you as the buyer to make sure that that 15% is withheld. Number 4, exceptions. Under certain scenarios, the 15% withholding can either be waived completely or reduced for the seller. But the buyer still has to sign off on it, because in the end, it's still the buyer's responsibility to make sure that the taxes are paid on the sale. So if certain bits of the scenario are just right, it's not unusual for the listing agent to contact the buyer's agent to say, hey, would the buyers be willing to sign a waiver so the seller doesn't have to withhold anything, or they can get a reduction? Now, in the last 12 years, I think all of my buyers have always said no. So that's a common answer, but it's not unusual for a listing agent to ask. So I don't want you to be surprised by that question. Now, please note, if, let's suppose 15% is withheld and the seller still owes more money to the IRS is not going to come back to the buyer for paying any difference if seller doesn't pay. So let's say seller, we withhold the 15%, seller files U.S. income tax, they figure out, oh gee, we still owe $2,000 more, let's say, and the seller doesn't pay or doesn't pay it in a timely fashion, the IRS doesn't go back to the buyer. You've already done your part by withholding the 15%, so you're safe. Now, for the sake of keeping this video as simple as possible, because I know this can be a complicated subject matter, I'm not going to dig into all the different scenarios that would allow a seller to either reduce the withholdings or have it waived altogether. Each seller, buyer, property, and situation is different, and so all those things are going to impact what's allowed and what's not allowed. And again, I'm not an accountant, but I do want to simply point out that buyers need to be aware of what the IRS requires of them if a seller is a foreign person. And buyers, you do not need to be afraid of buying from a foreign person. As long as that money is withheld, you're in good shape. Okay, I hope this helped a bit. I hope I didn't confuse you more through all of this. And if you do need to consult an accountant in regards to any tax issues related to real estate, please let me know. I can give you the name and contact information for a great local accountant for you to reach out to. And if you do know of a foreign person who's thinking of selling, or anyone who is actively looking to buy, please forward this video on to them so they can be mindful of FIRPTA and what might be required of them. Thanks so much for watching. I'm Jill Thomas with Berkshire Hathaway Home Services, Florida Realty.